welcome to the Altos Trading live strategy session with Jeff Tompkins. This is your host, Richard Van Rich, and we have Craig Ward with us, as always, in the chat. We're really excited to have you guys with us here this week. Got a lot of great information to go on. Markets are crazy volatile, so don't step away. If you do have to step away, don't worry. This is recorded and be available on the members area later tonight and sometimes on YouTube tomorrow. So if you have any questions at all throughout the evening, you just put those in the Q&A box, and we'll get to those periodically throughout and also at the end. If you have any questions about your personal account with us, membership, access, alerts, access to trade, anything like that, email support@altostrading.com, and we'll get to those sometime in the morning. So I'm going to bring on Jeff. Let me read the disclaimer. Altos Trading LLC and Trade Zillion software is intended to be used as an information service for subscribers and includes opinions as to buying, selling, and holding various stocks and other securities. However, the publishers of Altos Trading, Zillion software are not brokers or investment advisors and do not provide investment advice or recommendations directed to any particular subscriber or in view of the particular circumstance of any particular person. Altos Trading LLC, including its owners, do not accept responsibility for any decisions made by subscribers using the software, and subscribers to the Zillion software or any other person to buy, sell, or hold securities should do so with caution and consult with a broker or investment advisor before doing so. Right, Jeff, you're there?
Hello, everybody.
All right.
So now we know Richard can grow a beard in 1 week or less.
How about that, huh?
You guys
that. I eat bacon every morning, steak for dinner.
There you go. So that's the trick, huh?
I don't know.
I think my dad used to tell me that. He would tell me, red meat put hair on your chest. And it worked. Anyway, if you guys were on last week, you'll remember Richard had a fresh shave and a new boyish look, but
I know
it's all back.
My wife was just like, it's funny. Like I first grew it to begin with because I lost a bet with her. I don't remember what the bet was. Something about last time we went to Vegas, and she was like, I just said I couldn't grow it after a week because it got really itchy, so I just had to do it, and then I just got used to it. And my daughter liked it, and
yeah, it's always been my thing.
It's too itchy.
Yeah, getting past the itchy phase is difficult. Well, Rodney says impressive.
Appreciate that, Rodney. Checks in the mail. So what have you been up to?
Watching the markets, trying to make sense of all this chaos. It's crazy. Yeah. But that's what we're here.
Yeah.
Right, exactly. So yeah, we'll go over the our market overview. We're approaching the end of August. So kind of getting towards the tail end of the summer months, tend to see markets pick up a little bit in terms of volume and oftentimes bullish direction in the fall. So keep our fingers crossed there. So we'll review where things reside relative to the 36-month moving average. And tonight we're going to focus on using volatility expansion. If you guys have attended in the past or are familiar with our Slingshot setup, this kind of ties into that. And it's a kind of a way to use that to identify volatility expansion and market sell-offs. And we'll use the recent run-up in the markets and then subsequent sell-off that's occurred recently as a case study for how this can help us identify these. And this is good timing because we're actually in the midst of a volatility expansion right now in a market sell-off, right? So we're still early on in that phase. And so I'll show you how to spot that and then how to interpret it and how we can use it in our trading and investing decisions. And then hopefully we didn't have time last week. So hopefully this week we'll have some time for ticker roundtable. And then of course, Q&A. So I'm going to jump right in because I don't want to take away time from all of the good stuff we have to cover. And let's see, make sure my dashboard's updated here.
Yeah, I'm really curious to hear what you think about the market because from my experience, I feel like September has always been a little bit of a down month. So I'm curious to see if you think we'll continue that or not. Or
yeah, Yeah, I think, what's really going to be interesting is where we finish, relative to the 36-month moving average. Are we going to get any late month buying, which is basically tomorrow is the last day of the month. It's not looking like it, but we are near some support on the major indices. So I'm going to map those for you, but I think a lot of it's going to be dependent on whether these support levels hold tomorrow. So looking at the S&P 500, I'm seeing another big sell-off today. And we are kind of down in this area of support that caused some buyers to come back in. So kind of looking back to last year, that's going to be right around a half-century mark, around 39.50. Didn't quite get down there. So this is a kind of a support zone here. And so we dipped into this support zone. So the way that I identified this was from prior resistance from back last year, where we had, we were previously trading below and then came up into this support zone and then had some rejection and sell off from this zone and then finally broke through it. And we've seen a little bit of, price action around this level, this zone, or these levels more recently. Okay, and then today as well. This is certainly for tomorrow and through the remainder of this week, the zone to be watching for support. And any sort of a rebound from this. And then if we get a break of this support zone to the downside, I expect roughly 39.50 to 4,000 to serve as resistance. So I think it's going to be, I think these lows we put in back in mid-June, kind of above the 3,600 level, are unlikely to be retested this year. I think we've most likely put in the highs and lows for the year. So the high, the very start of January on the S&P, and then the low from mid-June. So I think we'll probably see markets somewhere, in between the high from January and the low from mid-June through the rest of the year. What's also significant and lends to more of a bearish case, and certainly so as we look at volatility expansion on our session tonight, is that we broke and closed below a millennial mark. So we broke 4,000 and closed below it on a day with a lot of selling and volatility. So that's more of a bearish case. But there can also be fake outs around these century marks, millennial marks. And so we need to also be prepared for that possibility, since we're in the support zone. If we see a close back above 4,000, not trading above, but a close back above 4,000 tomorrow, or before we necessarily, trade more within this support zone or break through it and trade lower, then I'll consider that a fake out with a potential rebound. So for now, we really need to watch this this support zone right here, and how price behaves around this zone in the coming days. So again, we get a close below roughly 39.50. Then I'm more bearish. We get a fake out of this 4,000 millennial break out to the downside, come back up, close above it. And again, I'd want to see it close with conviction. So a bullish candle with close near the high, and certainly any subsequent closes above 4,000 would just add to that bullish case scenario. Then I see, potential buying opportunity in a rebound. So for now, there's really not a whole lot of, resistance to be monitoring. But if that does occur and we close back above 4,000, I'm going to be looking at, roughly the 40-50 level as resistance. And then also, the 4,100 level. All right, so those are the big ones. If we break this support zone, this support zone down here between 39.50 and roughly, we could even call 4,000 the high end of the zone. But if we break that, I think we'll see a more dramatic sell-off into, probably the 38.50 level. So those are the main ones to watch on the S&P. And as we look at the NASDAQ, the Qs, we'll see kind of a similar scenario. So also, we're near a major support. I'm actually curious to see what the exact lows were here. So here we had a low at 297.45, and today 298.44. So less than a point off from this support low back on March 5th of last year. Look at that. I mean, so again, just like with the S&P on the NASDAQ, since we're watching, this was a prior level of support with a lot of buying pressure off the level. We came down and almost touched it today, and then had buyers come in and still obviously in the context of a downturn in the markets and in the midst of the sell-off, still had buyers come in at that support level and drive price back up from today's lows to some degree. Obviously still with a bearish close, but this is kind of more of a precise level to watch, but we'll still make a zone out of it because if you look, and this one's pretty tight, if you look back in June and July when the NASDAQ 100 was hitting these fresh lows for the year, my mouse just froze on me. And then we, as buyers came in down around the 270 level, continue to try to push up through this, what was previously a resistance area. So see, that resides just a tad lower, which is right around 296.37. Then that level that we touched today from back in March last year. So, so a tight zone, but similar to the S&P. This is our, we're at a potential inflection point with this support area. And so what we want to do is we want to wait and see, do we get a bounce? In this case, I want to see, today we closed above 300 on the Qs. So I'd want to see another close above 300 since that's a century mark for a bullish case scenario. But if we sell off, if the sell-off resumes and we close below the lower end of the support zone, then we have that higher likelihood of a retest into some of these lower support levels that we saw from May and June. Again, I think probably unlikely we come back down into the 270 support area on the Qs. Because if you look at the overall trend structure, right, a trend is defined as a series of lower lows and lower highs, a downtrend, right? So you're going to see a series of lower lows and lower highs. And in order for that to break in reverse trend, we need to trade above the previous lower high from that downtrend. And that was actually right here. So why was it not right here? Well, because these legs didn't go below this low in the downtrend. This is often a sign of a trend reversal. So as you see price start to move up without making a new low, and then especially if you see like consolidation or sideways price movement, those are often reliable breakout opportunities. But really to end the downtrend, we need to break the leg, the high of the last leg of that sell-off. And this all work in reverse for an uptrend shifting to a downtrend. So we did break that right here in early August, so technically we're still in an uptrend. But this sell-off has extended pretty deeply into this uptrend leg. It looks like roughly we're probably about at a 50% retracement from this. I'll just kind of clear this out so it's easier. So this uptrend leg from the lows back in mid-June, looks like we're kind of roughly at a 50% retracement on that leg. And again, that coincides with this support level. So we often see, a turnaround in a trend or a correction or retracement at a 50% level. So we could see support here. So again, we just need to watch, see if we get a bounce and can get more closes above 300 on the Qs. And then if not, if we break it, then this could then shift into a downtrend. But we would see this, again, series of lower highs and lower lows. So that's kind of basic trend analysis and how to really determine what the trend is. And so, like, just to give you another example, here we're in an uptrend. We're making higher highs, higher lows. This was kind of a shallow because we had sideways consolidation. But technically this shifted into a downtrend right here because we broke the previous swing low. So then this is our new, being in a downtrend, our new lowest high. So we need to break this to break the downtrend, which happened right there. We're in an uptrend. The more it gets a little more complex as you start to see, channels or ranging within these trends. So, when that occurs, like it did right here, but late last year, again, we're just using these lows as the previous lowest, highest low, because we were in an uptrend to determine when price closes below, to give us a clue that that uptrend has stalled and is likely to reverse. And so there it happened. So that's kind of trend, how you do the trend analysis on these. So right now we're still in the uptrend, but we're at a point where it's vulnerable to shifting back to a downtrend. So we need to really see this 300 level hold on the Qs. And then looking at all this in the context of the VIX, because remember, the VIX helps us navigate these turning points in the market. So as VIX comes up into resistance, and that resistance holds, while the major indices like the S&P and NASDAQ are at support levels, that can give us a clue that the trend is going to reverse, or the upward momentum is going to resume. So it's really crucial to watch the VIX. And kind of right around 29, we've got this strong resistance. But we're going to make a zone out of this as well, because we've also had spikes. So we kind of got down around that 19 to 20 support area again. All right, so this is our support zone. And as we reach that, and then volatility spiked off, moved to the upside into this resistance zone. So you can see that in past sell-offs and volatility spikes, we've had volatility contract, come back in from around this zone. And if you look at the price action of today and yesterday, we're getting we've had 2 days of rejection of that zone. So if we start to see the VIX come down off of this, that's our indication that those support levels that we just looked at on the S&P and NASDAQ are more likely to hold and price move up off of them. So it's the inverse correlation. We see the VIX hit a resistance zone and rotate lower, while the S&P and NASDAQ hit a support zone and start to shift higher. Now, I'll pause to see if there are any questions there, questions or comments. And then we're going to look at kind of we're going to look at the volatility expansion, not just by analyzing the VIX, but by actually analyzing the indices and even individual securities. This works this method works great on individual stocks, ETFs, currencies, futures. It works really great on multiple time frames. In fact, I traded this strategy live in a workshop we did with Ninjacators and Traders Agency a few weeks ago. I did 2 live trading sessions where I traded real money demonstrating this method, and we did 1 trade each day. Both of them were successful on a 5-minute chart. I think we did both trades off a 5-minute chart. So it can be applied to any time frame as well, because you get volatility contraction and expansion across all time frames and all asset classes. So along with the indice analysis and the VIX analysis that we do, this is a great method and tool to using in combination as we're doing this analysis. So Richard, any questions on the majors and the VIX?
Keith was just saying, watch out for the GDP report tomorrow morning. Do you take any of that stuff in consideration when you're looking at the week, or you look at more long-term levels?
Yeah, definitely. Yeah, absolutely. Yeah, watch out for that. Also, we got non-farm payroll on Friday this week, so there's a lot of things that are going to continue to probably pump volatility in the market, create uncertainty. Right now, there's a lot of uncertainty in the market. What's really driven the catalyst that really drove this recent sell-off was the Jackson Hole Symposium that the Fed attends every year in August, and Powell spoke, I think it was Friday morning last week, and gave, this very direct and hawkish speech that, basically inflation's obviously still very high, and we're going to, do what the Fed's going to do, whatever they have to do to bring it down, and we have a long way to go. So that it was a short and direct and hawkish speech from Powell that really fueled the sell-off, but the sell-off started before because of the anticipation and fear that was behind that. So yeah, these things all matter, the fundamental things, and especially in these types of economic conditions, things like GDP and non-farm payroll are definitely going to impact the markets. So also be aware of those. Yes.
Cool. Let's see if anything else is in there. Nope, that's it.
All right. So let's hop back over to the S&P. So I'm going to show you a way to kind of gauge these market moves using volatility and standard deviations. And so this kind of, we won't go through the whole slingshot, but basically we're going to use a little bit of trend analysis, but in a moving average type of setting. But we're also going to look at how to identify volatility expansion, because what that helps us do is determine, if we're in an uptrend, like we've had this strong uptrend over the past month or so, and then we get into this kind of unexpected sell-off situation. Well, how do we determine that there's a higher likelihood for these occurrences? And so we do that using the Bollinger Bands. So we're just going to add those to our chart, because what the Bollinger Bands show us, and let me know if you guys can't see the bands well enough, but hopefully you can see them. I'm going to zoom in here too. So what they tell us is where is price relative to a 2 standard deviation move, and you can manipulate the settings of the indicator, but you want to for the purpose of how we're using them, use what's usually the default setting on most charting platforms, a 20 period moving average for your center band, and then a 2 standard deviation setting. So basically just, you in your Bollinger Band indicator settings, put in 2 for the upper band and 2 for the lower band. So what that means is that these bands are 2 standard deviations away from the average. So that helps us determine, how far price is from an average price. And they're used a lot of different ways, but one of the best ways I think to use them, and probably also one of the most uncommon ways, and surprisingly a lot of people don't use them this way, is to identify potential up moves and down moves or sell-offs in the market. So generally when you see relatively low volatility, you're going to see the bands often closer together and often parallel, or even converging, moving towards each other. Or maybe you'll see one band parallel and the other one converging towards it. And that generally tells us that, the security is not making very strong directional moves at the moment. So you can see, like in the S&P, we're just in this low volatility range. And interestingly, if you look at the actual ranges for the day, they're fairly small, fairly tight compared to when you get a volatility expansion. So often what we'll see in a volatility expansion is we'll see the bands start to, the outer bands start to diverge. And that happens more dramatically in a sell-off. And then what we're also looking for is where is price relative to the standard deviation from the mean, the center band. And what we'll see, like in an uptrend, like we've had from roughly mid-July, is we'll see price come 2 standard deviations away from the middle band or the average and start to trail the upper band. So we're also seeing the middle band and then eventually the lower band both sloping up. So that's a bullish volatility expansion and what it looks like. So for a market sell-off, and I'm going to point out here as well, because we had this big run up. What's our indicator that this uptrend might reverse? It's when you see price trail the upper standard deviation band, and then you get a close below the average or the middle band. That is often a clue that price or the asset will sell off to some degree. So our clue is right here on this candle. And it was in the context of a previous strong uptrend or, bullish volatility expansion. So once that occurs, then what we're looking for is a bearish volatility expansion. And what that looks like is exactly what's happening now. So we had, and the one other thing too that gives us a clue of a potential sell-off is volatility contraction. So see how the outer volatility bands are converging now and moving towards each other, and they're tightening up. So we're looking for, after an uptrend or a move up in a security, we're looking for volatility contraction. And that, again, is the band, both the upper and lower band pointing towards each other. That tells us volatility is contracting, which is important because in the context of an uptrend, and if you look at this uptrend, the outer band never converged and pointed back down towards the lower band until right here. That was our warning. We actually also got a sell signal from trade trend up here that triggered, and it's still actually an active signal on the S&P. So the entry was kind of right around 4250 area, and is still an open signal with the S&P trading down below 4,000. So that was a great signal, particularly as we saw the volatility contraction taking place after this run up in the S&P. So then, again, then what we look for, close below the average, happened on this day here. And for a confirmation of and again, this is where the slingshot comes in, where what we call the slingshot is in volatility expansion is those previously converging bands diverging. So what that's telling us, so they're pointing away from each other, the upper and lower band. We're seeing the middle band turn over and start to point lower. So that is our clue that there's an expansion of volatility. And in this case, it's in the context of price trailing the lower band. So there's a sell-off. And what I'm looking for is price, so it didn't happen on this candle, is price to touch or exceed that lower band. So today and yesterday that happened. So often when this occurs, we'll see a more dramatic sell-off because we're getting volatility expansion. Outer volatility bands diverging, widening, average price turning over, previously in an upslope, turning over, starting to slope downward. And usually with significant volatility expansions, whether they're to the upside or to the downside. So this can be used for short trade setups, can be used for long trade setups. We see a return to the volatility expansion. But that should be taken in the context with the asset that you're looking at. With the major indices, since they have a long-term upward trending bias, it's less reliable to the upside. But it did actually happen here. So here was our volatility expansion. See, we had the band volatility contraction previously, bands pointing towards each other. They start to diverge. And again, with a bullish diverging volatility expansion, we really are looking for the upper band to move away from the lower band. And then we're looking again for price to touch or exceed just from the high, it doesn't have to be on a close, the upper band. And there's our volatility expansion. And then once that move is over and it either corrects or retraces to a level, it often will come back down into the level of the volatility expansion. So see how it started right here and we sold off right back into that level where buyers came in and started driving price up. So that also happens to the downside. In particular, it's very reliable to the downside on the major indices like the S&P because, again, they have a long-term upward trending bias. And when there's a volatility expansion and a sell-off, it eventually attracts enough buyers at lower price levels. So we're in the midst of one right now as price is trailing the lower band. So how do we determine, when that sell-off or volatility expansion? So we know it's happening, right? We're watching it right now actually happen. And we need to be careful that, markets are selling off and they could continue to sell off. How do we know when, the sell-off is potentially over and we get a mean reversion back to the center band or even higher? And that's where our support for a sell-off situation like we're in now, where our support analysis is important. So we're looking for previous levels of support to hold within this volatility expansion. So if price continues to trail this, we've got a century mark at 3,900, right? And we've got we have areas of support and resistance right around the century mark. So this could be a potential turning point for this sell-off and volatility expansion. So that's kind of how you spot it to begin with. Now, again, just go over it real quick. So we've got volatility contraction. In this case, to the upside, it was an uptrend. We start to see the bands, which in a strong volatility contraction to the upside will eventually be running parallel, all three bands. And our clue to when that ended, and we would be looking for horizontal resistance in this case, right? So there it was. We come up into this resistance level around 43.25, quarter century mark, and then we get a close below the lower band. And then next we're looking for price to touch or exceed that lower band while the outer volatility bands are simultaneously diverging or pointing away from each other. So that's what a volatility expansion looks like in the context of an uptrend or a sell-off. And how we can spot those, starting early on before the sell-off really accelerates. And then we want to, again, look at support for a volatility expansion to the downside to look for potential areas where the market might reverse. And so from that point, we need to, be patient and wait for price to move off that level. So we're looking for rejection of support and then a rotation higher. And that can happen obviously at any support level. So maybe that 3,900 doesn't hold and we move down into 3,825, which is a support level, or we move down into, 3,750, which is a support level, or we move down into 3,650, which is a support level, where we've had previous rotation higher from the sell-off. So these are all levels of support that we would map and monitor as the sell-off ensues. Okay, and then once we see indication that price is, that level's holding and price is starting to, buyers are coming in and price is starting to move back up off of that support level, and that could happen, at any level of support, that can help us identify when the sell-off is ending and a new uptrend is potentially starting. And then once that occurs, with a very high degree of reliability on the major indices, we see price and buyers come in and push price high back up into that level of volatility expansion. So where that sell-off started to trail the lower volatility band. So that'd be kind of right around the 40-50 level. So we'll follow up on this in future weekly sessions, but you'll see this, mark my words, this sell-off will end and reverse, and it will come back up to 40-50 at a minimum. Often we see, the slingshot, and that's why we call it a slingshot. We'll see price get propelled even higher as more buyers come in on the reversal. So that's kind of what it looks like and how you identify it, and how we can use that, to not just spot potential turning points after a run up in the market or after a sell-off, but then formulate strategy around it, for bullish and bearish cases. In this case, in a bearish volatility expansion, we'd be looking for bullish strategies off of these levels within the volatility expansion. So that's just on the S&P, and as we get here in just a minute to take a roundtable, we can look at this also in individual stocks, because again, it works really well across all asset classes in all time frames. So this is, of course, just the daily chart on the S&P, but this methodology can be applied to any asset in any time frame. So that's how we analyze volatility expansion, whether it's bullish or bearish, and where there's potential for turning points after a run up in the market or a sell-off. So any questions, Richard, there? Then we can kind of spill this over into our ticker roundtable so we can look at that.
Let's see. Manshu just said, and I agree 100%, that the analysis of volatility contraction expansion is excellent and it's very useful. And I got to say, like, for me personally, this probably the slingshot strategy is probably top 3 my favorite all-time strategies. And as you said, this works on all markets and all time frames. So this happens, several times a day. Find the right setup. I mean, it could be your bread and butter. It's that great. So I encourage you guys to watch it over again.
Yeah, it's definitely a bread and butter strategy for me. And it really gives you a lot of confidence to identify, turning points in the market and sell-offs, and because volatility, and it's really the true power of the Bollinger Bands, in my opinion, because they're used so many other ways, which I think are far less effective. This is really, I believe, the best way to use them, relative to how a lot of people use them, which is buying off the lower band and selling off the top band, because that fails very, very often. And when it fails catastrophically.
Let's see. Well,
yeah.
maybe before you go in and take a roundtable, could you look at the 36-month moving average?
Yeah. I just saw Chris's thing. Sorry, I forgot to do that. Yeah, thanks for the reminder there, Chris. I intended to look at that. So the 36-month average still holding. We did get, obviously, we only have one trading day left, so it's looking like very high likelihood. We've kind of got this bearish reversal this month off of resistance. So we might see a retest of the 36-month. But I think it has a good chance of still holding, to be determined. But right now, the good news is on the S&P, we're not this month in danger of closing back below. And again, when and if that happens, then we'll shift gears and talk about different strategies to handle that situation. But we're still, well above the 36-month moving average on the S&P. So that right now is at 37.75 and change, and then closed today 39.86, right? So we're over a couple hundred points above that, and with one trading day left in the month. So yeah, we're probably going to have a bearish close on the month, but on a more medium to longer term basis, we're still holding that level. But what happened is, so from June, we had this, and this was another volatility expansion situation. Those are kind of roughly the highs and lows from June on the S&P. And then in July, we had a strong bullish month, but highs and lows within the range of June. And that's why I'm always careful when you have what would often be termed like an inside candle, or there's different names for them, but you always have to be careful with those, that you get a false breakout. So that happened this month. We broke to the upside, went into resistance, and then rotated lower back into the range of this candle. So from here, we're really watching what does price do within the range of July, because almost certainly in September, we're going to break either the lower or the higher range of August candle, maybe both. But the key levels now to watch on a more medium to longer term basis are the highs and lows from July from this candle. And then again, the 36-month moving average, which we're still well above on the S&P. On the NASDAQ, we're much closer. So not out of the realm of possibilities that we could close below the 36-month moving average tomorrow, but we need pretty accelerated sell-off. Could happen because we're in a volatility expansion to the downside. So we're going to watch this one particularly close. Tomorrow, do we close below? And then going into September, since we're in much closer proximity. Good news is there's confluence between the 36-month moving average and a previous strong level of support from earlier in the year. Last year, earlier in last year. So you can see how strong this level of support is. So even though 12,000, the millennial mark for the NASDAQ, the next lower millennial mark, is currently below the 36-month moving average. I'm also going to be watching 12,000. And am watching it right now. If we see a close in September below the 36-month and the 12,000, then we've got a very significant bearish scenario to consider. So that's where things are with that.
So let's see. Someone says, do you use the 36 month moving average as your, say, definer bear versus bull markets?
Not so much, more for buying opportunities on, I'm gauging it, using it more to gauge like, like ideal places to buy. The major indices tend to spend very little time below the 36-month moving average. So it can create good buying opportunities when you're near or below that. But as far as like determining bearish conditions, it's really a peak to trough, scenario where you're looking at the previous high to the previous, well, really the current price, and whether you're at a peak to trough of 20% or greater. So if you're trading 20% or more below a previous high, then that would be considered bearish, even if you're above the 36-month moving average. But this is a really good, value area that can create, buying opportunities. So if we do dip below, we could see, an acceleration of selling in the markets, but again, eventually that will attract buyers, and price will ultimately, return back above the 36-month moving average.
All right, gotcha. Let's see. Charles wanted to know, a lot of people use 1.5 standard deviations for Bollinger Bands, and you typically use 2. Do you think that's better?
Yeah, I think I prefer to use 2 standard deviation move. The lower you go on the standard deviations, the more false, using it for the purposes that I demonstrated tonight, you're going to get more false indications of a volatility expansion. I found 2 to be kind of the sweet spot, and probably the most followed, by other traders and investors.
All right, so we got.
All right. So if you guys want to suggest some tickers, we can take a look, and we can also look at volatility expansion cases with those. So if you guys want to type in the chat any stocks or anything you guys want to look at, we can take a look at those and see what's going on. All right.
Let's see.
AFRM. All right, so this is a Firm Holdings daily chart, and also in the midst of a volatility expansion sell-off, right? So let's see, we had big run up in price. So this is kind of what we call a reverse slingshot. Price trails the upper band, return back to the original price of the volatility expansion. We get the close below. We get price coming down into the lower band. We have a volatility contraction, outer bands pointing towards each other. As price is trailing the lower band, so we know we're in a sell-off situation. Volatility bands are diverging, pointing away from each other, and price has touched and exceeded the lower band. Now 3 days in a row, 3 trading days in a row, Friday, Monday, Tuesday, and price is trailing the lower band. So our expectation is obviously a sell-off in the stock, and we want to look for potential levels of support where price could turn around. So I'm just marking a few of those here. Really for great opportunities for a reversal after a sell-off back to the upside, we want to see a fairly deep volatility expansion. So we want to see price trail the lower band for a number of candles. And I typically like to see, 6 to 7 minimum candles trailing the band, the outer band, in this case, the lower band, in a sell-off, to create ideal buy-in opportunities on a reversal. So it would probably take, at least a few more candles to get down to this support level around, a little above 20, it looks like. Maybe around 2050. So this is the process, and be looking for one of these support levels to hold and price to reverse off of it. And when that occurs, I know where my initial profit target level is going to go, near the initial volatility expansion level, which is kind of right around 25. So it can help me plan my trade. If I want to structure an options trade, let's say around this this methodology, and let's say price comes down into the, right around the 16 support level, this one here, and starts to reverse back up, then that tells me I've got about 9 points of potential profit on a reversal from this volatility expansion, and a move back up into where that expansion initiated. That's a huge upside potential from down at that level. So I can structure, the appropriate strategy to take advantage of that potential price move. So yeah, this is a good one to look at. Also, there was the sell signal here, which is still open. So entry would have been kind of right around 36 or a little bit higher. And this thing's already made, like a 13-point move off the sell entry from this bullish slingshot or volatility expansion. So that's the other thing we can look for. We can look for trade trend buy and sells off of these volatility expansions. So for the bigger potential moves, we'd be looking for sells off a bullish volatility expansion. We're looking for buy signals off a sell-off or bearish volatility expansion, like we're in now on a firm. So particularly if we can get one of those at or near or follow, shortly following one of these support levels holding and price reversing off of it, this can be very high probability opportunities. So thanks, Manchu, for suggesting that. That was a good one.
Let's see. How about Walmart?
All right.
Charles.
All right, interesting. So, and this is also a good one to look at, because I often avoid trading a security when it's near the average, right? Because we had although this one wasn't particularly tradable because of the big gap up in the stock back in mid August, we did have a bullish volatility expansion. So you'll notice how the outer bands were diverging and price was trailing the upper band. And and also interestingly, we got a sell signal here off the rotation lower off the upper 2 standard deviation band. Then we get a close below the middle band. Second one today. Right now, the bands are very far apart and moving parallel. So again, in order for this to really work to the downside now, and price would have to move down significantly from where it closed today around 132.5 to down into the lower band, which right now resides around 124.50. And then we'd be looking again for the outer bands to start diverging and price trailing the lower band. And if that happens, there would be very strong buying opportunities down here around 118 with profit target levels around 124.50. But right now, it's kind of in the middle zone. So this middle area can be challenging to place trades off of. So the methodology also helps me stay out of a lot of trades. So I find that my higher probability trades are off of extremes where price is at or above a 2 standard deviation move to the upside or downside from the average. Because then you have more potential for a move or what we call a mean reversion, and a contraction of volatility after you get one of these volatility expansions. So I avoid, trading stocks that are with using this methodology that are near the center band or the average price, which right now is the case with Walmart.
All right. A lot of others in here. Let's see. UNG.
All right, so United States Natural Gas Fund. Here is a bullish slingshot or volatility expansion. See how eventually sellers came in around this resistance zone and drove price back down into where that started. So a bullish slingshot or volatility expansion that completes itself looks like a triangle. A bearish volatility expansion during a sell-off looks like kind of an upside down triangle. Also, in this case, finding support near the middle band. Price resides kind of near the average currently, but above. We're starting to get volatility contraction. So see how the outer standard deviation bands are starting to point towards each other. In this case, that could be an indication that this level at the center band might hold and price could move back up off of it. Because as we see volatility contract, often at any of the bands, whether it's the outer bands or the middle band, and we see in this case bullish rejection of the mean or the middle band off of a support area, could indicate as a continuation of an up move in the security. But again, it just is more difficult to trade this around the middle band. We want to look for extremes in price where it's moving at a 2 standard deviation distance to the upside or downside. So here is another bullish volatility expansion. So see the outer bands are diverging. Middle band is pointing up, price is trailing the upper band. There's our resistance level. This is a good one because we got a sell signal, right? On this one. And then price came back down to the volatility expansion. Here we didn't get price coming into the lower band and then a volatility expansion from there. We got volatility contraction. This is actually what could be happening now, what I was talking about. So see how we're getting volatility contraction, outer bands pointing together, price moving up off the average, the middle band. In those scenarios, we often see continuation of the up move to some degree. Again, a bit more tricky to trade, but you'll see that we've got, again, still we have the volatility contraction. And then that's where it led into this second bullish slingshot that we just looked at. So right now, we're not trading at an extreme in terms of volatility or standard deviation moves from the mean on United States natural gas. So right now, indications are telling us that we're in volatility contraction and we're in an uptrend. And if I were to trade this, I would be looking for price to come back up above the high of the candle. So I'd want to see price come back above 32, and that could create a long opportunity. Bit more of an advanced topic, not kind of off topic from the purpose of what we're analyzing today and how to use volatility expansion, but just kind of a nuanced way to use it. Let's take one more.
All right, let's see. How about Lisa asked for Shopify? SHOP.
All right, so this is an interesting one actually, because technically we have not hit a 2 standard deviation move. So see how price hasn't actually touched or exceeded the lower 2 standard deviation band. But we're still getting volatility expansion. Oops. So we're getting diverging outer bands and we're getting a sell-off. So sometimes you'll see this happen where we are still kind of trailing the lower band and we're getting volatility expansion. And we've got a sell-off. And the average band, the middle band has rotated lower from following an uptrend. So although this doesn't quite meet the criteria, it's very close. And so this is, again, what we're looking for in a volatility contraction or expansion to the downside during a sell-off is some strong level of support. So there's a really strong level of support around 30 to 30, 50, kind of right, really between 30 and 31. So if that holds, then likely we'll see a move back up and a retest of roughly the 33 level. So that's kind of the process. You look for these obvious levels of support as we're getting a sell-off. And same thing to the upside. Look for very obvious levels of resistance in a volatility expansion to the upside. Another good one to look at. So kind of in the midst of a volatility sell-off expansion on Shopify. All right, those are great ones. Thanks for suggesting those. Hopefully you guys got a lot out of that method and way of analyzing volatility on specific securities. We'll continue to use this and kind of use it to build on other strategies in future weeks, and start tying it in with other actual trading strategies. For now, I just really wanted to go over the way to analyze it and use it to identify uptrends and downtrends, market sell-offs particularly, and certainly since we're in a volatility expansion right now on the major indices, I thought it was appropriate to really look at that and use it currently to spot potential reversals back to the upside in the S&P and the NASDAQ. So again, yeah, we'll continue to build on that in subsequent weeks. So any final questions for tonight, Richard?
Ed has a good question. I don't know if it's something that we want to tackle this week or kind of pause it for next week. We had kind of a callback to last week about how to do trade management with that collar. If price goes up.
Yeah.
Do you just let it go to expiration and take the max loss on the credit spread, or total loss for buying the put, or
yeah, good question. So we didn't really get into structuring the size of the collar relative to the equity position. But the rule of thumb is you want to use one contract for every 100 shares. So when you're buying the put, you want to use one contract for every 100 shares of stock that you own. And then of course you're doing a 2-to-1 ratio on the call credit spread to finance the purchase of the put. So let's say you owned 100 shares of a stock. In order to create that hedge, that downside hedge, you would buy one put contract and then sell a 2 contract credit spread, because you're doing that 1-to-2 ratio. If you do it that way, even if the stock reverses and starts going up, the appreciation in the price of the shares will outpace the loss in the hedge, because you're not fully hedging the position. So it's not a bad thing that you have the hedge there for protection, but then the stock actually ends up going up. That's okay, because the appreciation in the share price will outpace the loss in the put in the credit spread. If you do it with that, structuring it that way with one put contract for every 100 shares of stock you own. So as long as you want a hedge in place to protect your equity position, you would just keep it and let it run. If you don't feel like you need the hedge, you can, at your discretion, close it out if you can salvage any premium in the put and call spread. Typically, if I'm going to, hedge a position, I'll often just keep it hedged. And even if the hedge ends up not being needed, the move up in the underlying security should still produce profits when you're using that hedge ratio. And then for closing, and we'll get more into that one again, maybe next week we can revisit and kind of talk more about the position sizing and how to do that, because, and then also like when to close them. Because also, if a sell-off does occur and your hedge is making money, generally when the put moves in the money, and is protecting me, I'll close the hedge and then reestablish a new one at a lower price. So take profits on the hedge, establish a new one. And then even if the underlying security reverses and moves back up, you've booked profits on the first hedge. You may lose some on the second, but it all, as the process plays out, tends to work out, even if the stock starts running up, because it's if you structure it correctly, it's the way a hedge should work. It shouldn't completely and perfectly hedge the downside. Otherwise, when the hedge isn't needed, you wouldn't make money when the security goes up. So it's important that you size it right and then manage it correctly. So that's kind of from a high level how you would manage that. But we'll dig into that more possibly next week. Which, by the way, are we doing a session next week? I think so. Next week is a 3-day. We got a 3-day weekend coming up. Markets close Monday. I think we'll probably still meet next Tuesday. We'll let you guys know if that changes, but yeah, we can get into that in more detail. Good question.
That's all I got. Keith said, thanks everybody. Jeff, Rich, Craig, happy and safe Labor Day.
Yes, happy and safe Labor Day to all of you. I hope you guys have a relaxing time off and spend time with family and friends. Be safe. Again, markets will be closed next Monday. So hopefully everything we covered tonight will help you guys navigate the markets tomorrow at the close of the month, as well as through the remainder of the week and beyond. We'll plan on seeing you all next Tuesday. Again, if anything changes, we'll let you know. There's a chance we might extend that out to more mid to later in the week, just due to people traveling for the holiday and things and getting back to work. But we'll keep you posted. So have a great rest of the week. Thanks so much, everybody. All the great questions, and we will see you next week.